Okay, very good morning to everyone. I'm going to begin, and I hope you're all well. Let me just do a very quick sound check. If you can just unmute yourself and say hello, good morning. So I know my speakers are working. Hello, hello, hello.
Hello, good morning, Sam.
Oh, good morning. Was that John?
Yes, this is Zhongyuan.
I hope that you are all well. Just because I'm still letting people in. Now this morning, a few things to share with you. Let me just start with just some quick housekeeping things. So today is April the 9th, 2022. We are well into quarter two, the second quarter of the year. For some countries, it is actually the start of a new financial year. Hong Kong, for example, the so-called financial year starts on 1st of April. Okay, and it's not a joke; it's real. So we, what I want to do this morning. So you've already done one of your assignments, I hope, and there is just a few more elements. So there is a group project which is actually worth quite a lot and will include peer review as well. And then there are two exams coming up. One is the midterm, one is the final. And I'll talk a bit about that in a moment. So here's a calendar, and I was just looking at it before we started. So today you will meet with Ruben one more time, but after that we have a break, and when you come back in 2 weeks time, so 9 plus 14 is 23, there's a little E there. This is when we have the midterm exam, which will be in the afternoon. It's going to be 2:30 p.m. on Saturday, April the 23rd. Okay. Now, reluctantly, we will be meeting. I mean, I really felt we didn't have a choice, but this is today. This is you guys, and in between today and your midterm exam 2 weeks from now, we will meet one more time. Now, I put that in there on purpose because my experience is that some people will have questions, and this is the best chance for you in the next week. If you have questions on the course, please feel free to send them to me, and if I can just get a little preparation, I can give you a better answer. Okay. And some people have written to me, and I'm always very grateful for that. I'm going to show you in a minute what I have received, and those questions will be tackled and shared with you. Okay, so that's the calendar, and then the lectures will resume for 5 more weeks. And what we will do during the last 2 weeks, it seems very far away. Well, it's not that far away. During the last 2 weeks, we will have your group financing proposal presentations, where we're going to have 4 teams present in perhaps week number 10, and another 4 teams in week number 11. So each presentation will be 15 minutes approx. So that takes just about an hour. And then the other 4 teams will be the week after. But everybody will have the hand in their work. Quite likely, let's say 2 days before the closer deadline. So let's say May 19, okay, tentatively, because we need to have a look at it as well. So let's just say May 19, we will need to set the deadline for your group, your financing proposal for that date. Okay, just giving you plenty of advance warning now. So here is the okay. So we've had so far. You have met with Ruben 4 times. Today is meeting number 5. So you met with him 4 times. All the links for the videos are in here. 1, 2, 3, 4. And this file that you now see, that is also in Blackboard. Okay. And where I thought it would be helpful, I've also put our sessions in video format and shared with you, but not every time. Okay. Now, as far as housekeeping is concerned, assignment 1, I hope you managed to hand it in last night. Okay. You should upload 1 copy to Blackboard and 1 copy to VeriGuide. So if it's not clear by VeriGuide, I can't really mark it. The midterm exam will be in the afternoon of Saturday, April 23rd. It's going to be an online exam. I'll tell you more about that perhaps next week, but the format, I am guessing, will be likely to be a combination of short questions and multiple choice. So there'll be some concept questions and there'll be some calculations lasting for roughly let's say 2 hours. Okay, something like that. Anyway, more on that next week. And I will also need you to observe, the standard protocol. And if you have worked with me so many times on online exams, I think by now you are familiar with that. Camera from the back, your left or your right, indicating your screen and what's in front of you, and so on. Okay, so but we'll talk about that perhaps next week. And then now the financing proposal is a group project that you do amongst 5 or 6 of you, and you imagine that you are an investment banker and you are about to visit a corporation, and you're going to advise them on how they should raise additional funds. Now, these meetings, they happen all the time. Sometimes you ring up a big client, Tencent, Alibaba, China Life, and you knock on the door. Hey, can we come in and have a chat with you? You don't just go in there and have a coffee and talk about the weather. Okay, so you want to try and bring something concrete. Even if they never said, "Oh, we need some money," it is up to you to start that conversation and then discover, what they need, and then perhaps draw their awareness or bring to their attention things that they may not even be aware of. So that is the way an investment bank will add value. Now, so you do that, and I think all the memberships are all lined up already. So thank you for that. I have left the Google Sheet there for now, and what you need to deliver are 2 things. So there's a little PowerPoint. Now, don't go crazy with the PPT because it is a 15-minute presentation. The PPT is there for you to share your principal findings. And the report, which you also will be writing with your teammates, 1.5 to 2,000 words, will contain, I guess, a lot of the details that you are not able to communicate in that 15 minutes. So it is your judgment how you want to make one of them complement the other. Okay, but these are the deliverables, and then so these won't, it's not going to be a very long presentation, because we do have a lot of students. We need to give them a chance to present. Just give me a quick second, please. I'm going to check something here. The reason I paused just now, I saw in the chat box there's a question from someone. Is this an open or closed book exam? No, I can't. That is subject to confirmation. Okay, but I think it's likely to be open book. But there can be limitations. So open book can mean you just can refer to your notes electronically. And doesn't mean you can Google everywhere, but I think it's likely to be open book. I don't know what it is that students like open book exams. They think that because an exam is open book, it is easier. Well, judging from the historical data, and as a finance professional, that's what I work. That's what I work on. Judging from historical precedents, open book exams never are easier. If we allow you to access, learning material, then the type of questions that we will ask are likely to be very different. In other words, they wouldn't be simple questions where you can just scroll and string search for an answer and so on. But anyway, I think it's subject to confirmation, but I suspect it's going to be open book. Okay. Is that okay with everyone? Can you hear me? Can you hear what I just said just now? I think that's an answer that you want to know. Can you all hear me? Okay, cool. Thank you for that. Now, okay, some people are still coming in. Now I do have a few things I want to share with you, but first of all, let me get this out of the way, because I meant to do this last week. And just very quickly talk about the practice of short selling, because I think most of you are familiar with it, but for those of you who may still have problems, this is a concept that you absolutely have to be completely comfortable with. Otherwise, 50% of investing and trading just doesn't happen for you. Okay. Now I have a diagram here on short selling, but the way it works is, when you are the ordinary investor, is always told you should buy low, sell high, buy low, sell high, although we all know how difficult that is. Buy low, sell high, buy low, sell high. But yes, buy low, sell high, but it doesn't have to be in that sequence. It can be sell high, buy low. Okay, and that in essence is what short selling is all about. You don't buy low, sell high. You sell high, buy low. Okay, and hopefully you don't sell high and buy higher. Okay. Now, if you think that the stock price can go down, so if you think the stock price will go up, of course you try to buy low, sell high. Okay, that's what I've been trying to do for the last 2 decades. But if you think the stock price is likely to head in the other direction, then yes, you sell high, buy low. Now the thing is, then how do you do it? How? When the way you do that is, so if this is okay, let me do that. PC has frozen for some reason. Okay, just give me a second. My PC has frozen. So to talk about, thank you for that, Raywan. So to talk about short selling, it is good to start by talking about the long side. The long side is just very simple to understand. So the bank, if you are the investor, you borrow some money from the bank, you borrow $100, you go to the stock market, and then with that money that you borrowed, you buy some shares and you put the shares with a safekeeper. Now I draw this box here for a reason, because you're going to see the short selling parallel. Although this is just a minor operational detail, to be honest. But if I just replicate these boxes exactly, and if I can shrink this a little bit, I'm going to put them beside, and I'm going to show you what happens. And you will see that there are just very interesting parallels when you are going short, because the boxes don't change, but the arrows don't change, okay? But the things that you are passing through, they change. So for example, here, this one can be your stockbroker, and you're not borrowing money in this case. You are borrowing stocks. Now, so apart from money, money makes the world go round, and money is the thing that it's the thing that we borrow most. But you can borrow someone's car if you want. You can borrow my phone. You can borrow money. You can borrow bonds. You can borrow shares. So now you are borrowing shares, and with that, you go to the stock market and you sell your shares or your stocks, get money. So let's say it is still $100. This is why I had that box, the custodian box. So now what do you do with your money? Well, you can put it in a bank. So banks now become your custodian for your cash. But you can see on purpose, the boxes have not changed, the arrows have not changed. It's just what gets passed through, those things are changing. So on the long side, a happy ending would be, okay, use a different color. I'll use the blue color. Okay, so happy ending would be you get your shares, and then later you sell your shares back to the stock market, hopefully because you bought low and you're now going to sell high, so you sell it at 110 and you pay back just 100 plus interest. Never mind. And the rest is for you to keep. Now over here it's rather the opposite. Okay, so here you would not get, you're not going to recall your shares back from the custodian, but you're going to recall that $100 plus a little bit of interest. All right, but never mind the part about the interest. And then hopefully, when you go to the stock market, you can buy back the stock at a lower price, and the lower the better. So let's say you just pay 85. So you sold high at 100. Now hopefully you buy low. And then that stock that you get, you return it back to the stockbroker. Now, actually behind the stockbroker, there is probably another investor, but this doesn't matter. Just like in a bank, you know, technically there is a depositor somewhere, but this is just a minor detail, depositor. So they will return the stocks back to that. But look, don't worry about that. And if you want to go to the next level of detail, actually there's stock lending fee and stuff like that. But in essence, you know, when you are short selling something, it is good to compare it with going long, because the boxes don't change. The number of boxes are the same. The number of arrows is the same. It's just, you know, things that are transmitted from one to another party, they are different. Okay, so I hope everyone is okay with that now. So these notes here say pretty much the same thing. Okay, now that's the first thing I want to share with you. The other thing is, just to help you out a little bit, I will just hold on. I'm going to just show you what has been done in the past with these group projects, these financing proposals. And now let me show you. There was an example last year on, I think this is Sinopec. So some team did a project on Sinopec. Now this is the report for 1.5 to 2,000 words. You can see down there on the bottom left-hand corner, it says 2,136, but that includes references and title page and this and that. So just a little bit of background. If you are going to visit a client, you probably don't need to tell them too much about their background, except to bring out things that are relevant to your discussion. For example, you know, what does their balance sheet look like? What is the degree of their leverage? And, you know, how much have they issued in the past on bonds or CBs or equity and this and that? Those things are relevant, yes. But you don't need to tell them, oh, you are good in the, you know, petrochemical refinery business. Well, they know that. Or how much money did you make? And so here is just talking about the market and the demand for capital, and then a summary of this client's likely issuance structure, depending on what they want to do. So this is bonds in US dollars for 5 years. There is an interest rate analysis. Now, Taylor rule is, I don't know, maybe quite technical for a commercial presentation. I mean, you can mention that. I mean, I'm not going to stop you, okay? And then qualitative analysis, and then the bond market in Asia and globally. Now, I'm not saying, I want to emphasize, I am not saying you must do it this way. I am just giving you an idea on, you know, how others have done things. So that was the report. Don't forget, it is, if it's 1,500 words shared among 6 people, you don't need a calculator. You know that 1,500 divided by 6 is 250. 250 words per person. some of my emails are longer than that. Okay, so we think that the workload is quite reasonable, and this was the PowerPoint that went with it. So as I said, there are a number of sections. So introduction, financing demand, or Sinopec, interest rate. So this is, I guess, a summary reflection of, the more detailed coverage in the report. So PowerPoint, by now you should know what it is good for, what it is not good for. It is good for communicating facts, tables and figures, and computations and matrices. It is not good for very, very, textual. So you don't want to slap on a whole essay on one page. That's not what PowerPoint is for. It's good for things like this, isn't it? And then, I mean, how do you communicate a graph to an audience except showing them the graph? And then, oh, this is good. Okay, so bond issuance, what's been happening in the industry and in the market overall. So here is, evidence that we can see you've done a good deal of research. And if you add that with your own analysis on what they should do and why they should do it, I think we would be happy to see that. Okay, and then some conclusion. That's one of them. Hang on a second. Okay, now I'll show you one more. Yeah. So the other one was on TSMC, the semiconductor people. And I'll show you the PowerPoint first. So this one was done quite well. It's decent. And I remember I enjoyed listening to them. Hold on. And so there's a little bit of industry analysis on who, like I said, this one plays itself. Okay, I'm not going to play it. And then some company analysis, but this be brief and be precise. Okay. And then financing demand. Why is it that they need money, and what are they going to use it for? Just some quick analysis on the financials. What are the options apart from equity? So equity financing, debt financing, and issuing CBs, which Ruben will talk about in the coming weeks. He trades CBs at his firm. Okay, so that's his expertise. So if you were to do this by way of issuing a corporate bond, what might it look like? So you can propose 5. So there are 3 tranches here being proposed. And why are you doing that? You probably then want to take into account the current debt profile of the company. Where does it have maturity coming up? And then okay, this would be useful. So historically, where has the market's bonds been trading? Okay, Then compare. Okay, now this page is comparing. Interestingly, it's actually comparing bonds with similar rating, but these are from very different businesses, like comparing TSMC with Visa and Chevron and Nestle. So these are not in the same industry. Qualcomm. Oh, okay, that's closer. Okay. And then market. Okay, market demand, and so that is. So you have to remember you can't talk that much in 15 minutes. And what you cannot communicate during your presentation, we will look it up in your little report. So make use of that 1,500 to 200 words. So again, 2,124 words. If you are plus or minus 10%, I think you'll be all right. Okay. So it doesn't have to be exactly 2,000 words. The company analysis, again, make it relevant. Financing demand, what they think the company will need. And then the need for process breakthrough and new capacity brings high capital expenditure. Okay, this is when you need to drill down a little bit more into what is the strategic direction of the particular company you are looking at, and then to maybe they have some special needs for acquisition. They're trying to take over or expand their businesses elsewhere, and so on. Okay, this one, yeah, it was done quite well. It's not fancy, no page number, but some good, useful information. All right, is everyone okay? And some references at the back. So I hope you all know what to do. All right. All right. Now, another thing I want to do this week actually is I received some questions from some of you, and I'm always happy to hear from people. And this student actually took the trouble to write to me a whole load of questions, and because some of them were very good, and I think you writing to me is, in my experience, the most efficient way for all of us to learn. And for me, you are helping me help you, because then I get to focus exactly what is bothering you. And given that we have a midterm coming up in 2 weeks, if you have any queries, feel free to let me know. And some of you have written to me, and I have put those emails aside, and I will deal with them. Okay. Now, is Shu Fan there?
Oh, yes.
Good morning. I just want to let you know I received your email last week, and I gave a very quick reply this morning before the class started. I will come back to that in more detail. Okay, but there is an email in your inbox. Yeah.
Okay, thank you.
You're welcome. Now, so let's take a look at this because everyone will benefit from it. Now, so here's a first question. The CET1, the Common Equity Tier 1, must be at least 4.5%. But there's also a requirement stated that there is a minimum loss absorption trigger of 5.125. What happened there? So my question is, does that mean banks need to maintain at least 5.125 CET1, not 4.5 after all. Now, that's a very sharp observation. It seems that, you know, in 1 minute, we're telling you that the CET1 should be 4.5, which we do here. And then they start issuing these instruments where there's a loss absorption trigger that will happen at a higher level. So if you don't have at least 5.125, you can't even issue this sort of instrument. So the question is, does that mean banks need to maintain at least 5.125 CET1, not 4.5 after all? The short answer is yes. So this effectively has lifted the floor. But you know, so this is the page. So this person, I am so grateful. This is the page that talked about these AT1 additional tier. Now, what's AT1? So additional tier 1 are principally pref shares and also what we call high trigger COCOs. Now, more on that in a moment, okay? But if you add the AT1, there is an additional 1.5% required. And I want to just show you, and here it says, okay, so, and we can read this very quickly. Okay, now the Capital Requirements Directive, CRD version 4, sets a minimum loss absorption trigger of 5.125 common equity, meaning that all AT1 capital instruments must either convert into ordinary shares or have their principal amount written down, written off, if the ratio of the firm's CET1, not AT1, okay, to its total risk-weighted asset falls below 5.125. So you can always tell when someone has read the notes very carefully. So she's saying, well, doesn't that mean that the floor has effectively been lifted from 4 to 5.125? Now, so as I said, the short answer is yes. The thing that, you know, the thing with the Basel framework is that it is a common, you know, international banking consensus. But when after the central banks meet in Basel and they take that common framework back to their own country, how they implement that, subject to local conditions, there's room for adjustments. And the Capital Requirement Directive actually is a European concept. And allow me just to show you quickly just exactly what that is. Now, I have here, and I think I have already put it into Blackboard. Okay, but I'll show you here. Now, I mean, you don't have to look into Blackboard right now, but I have a very short piece here, actually written by the CFA Institute on CRD Directive. Capital Requirements Directive number 4. This is very brief. This is only 3 pages. Okay, and but just reading this, it gives you some idea. Now, there are 2 reasons for this directive, and it is not the same as Basel III. So first of all, Basel III is not a law. It is a recommendation. It is the latest configuration of an evolving set of internationally agreed standards developed by supervisors and central banks. So these are recommendations and it has to go through a process of democratic control as it is translated or transposed into European Union law, being made to fit with existing EU laws or arrangements. Okay, now, and the other thing which is also quite interesting, now the Basel framework is supposed to apply to internationally active banks. You probably never thought of that, because all the banks that you know about, all the banks that you see when you walk down the street, they are international. You know, not just Goldman Sachs or JP or HSBC. Okay, Bank of China, ICBC, they're all internationally active. Okay, but in the EU, they have made this directive, which is an interpretation of Basel III. They made it applicable to all banks, and in Europe there are 8,300 banks, and they do so because, you know, the European Union is a very diverse basket of 27 countries. So when you are in the EU, even though you are a local bank in Greece or in Portugal, you can deal with anyone in the EU. So practically it is, you know, almost international environment in a way. Okay, now, so here, bank capital. Now here, this is the interesting part. So the purpose of CRD4. So this is just a European demonstration of how these things actually get implemented. Will effectively implement the Basel III Accord, including specifically how much and in what form capital must be maintained. Now look at this. So they have twisted it a little bit. So through this mechanism, banks will have to meet Tier 1 capital requirements, currently defined as equity capital plus all non-debt of at least 6% of risk-weighted assets. The highest form of Tier 1 capital is common equity. Now these are shares. Common equity Tier 1, which has to be at least 4.5 by 2015. That's already 7 years ago. Okay. Look at this. So in line with Basel III, the CRD proposal creates five new capital buffers. So you can see why banks are having such a hard time. So the capital conservation buffer, the counter-cyclical buffer, the systemic risk buffer, the global systemic institution buffer, and the other systemic institution buffer. Now, if you look at this little footnote number 2, so beginning January 2016, the CET1, the T1, which includes the AT1, so T1 is CET1 plus AT1. For all banks would increase by 2.5%. So that means if it was 4.5 before, well, it's now going to become 7 anyway. It becomes 7 because I say so. Okay, I meaning I'm the regulator in Europe. So that is the long answer. The minimum ratio didn't stay at 4.5 for too long. Okay, and you have to read these things carefully and actually look for clues on how things have changed. All right, now let me quickly. So I hope this is useful for you. It will be relevant. It will be very relevant when you join a bank, and if you join a European bank, you're going to hear this stuff every week. Okay. Now, question 2. May I ask if the 1.25% is the maximum amount of GP to RWA, and if this GP is like the allowance for bad debt expense account. What's GP? General provisions, okay? And from my understanding, the rationale behind this limitation is that banks should control the possible loss on its loans. If the estimated loss is too much, then the bank will fail to meet this requirement. Therefore, it would increase the bank's incentive to monitor the loans, and banks also tend to maintain a lower level of riskiness. Yes, this understanding is largely correct. Now, if you look at Tier 2 capital, which refers to is the second or supplementary layer of a bank's capital. So remember, when there's a balance sheet, so that there's the Tier 1 is here. So Tier 1 actually will take losses before Tier 2 does. Okay, and now what does Tier 2 include? Well, things like revaluation reserves, so when an asset goes up or down in price, that can change the balance sheet on the right-hand side. Also, general provisions, or GP as our friend called them. This category consists of losses that a bank may have of an as yet undetermined amount, including from loans. Now, this is the thing. So general provisions is a bank saying, well, you know, if I have a general provision, if I have a balance sheet of 100 billion, and I think I'm about to lose 25 billion. Now it's a lot of money. Okay, I'm about to lose $20 billion. There's a process that you go through before you write them off and tell your shareholders, well, we're sorry, we lost $20 billion. There is like a halfway house where you say, all right, we're going to make general provisions. We haven't lost it yet, but you know, we think there is a likelihood that we are going to lose this money. So the thing is, you can't just keep putting things in the general provision, because then you have not recognized your loss. So there's a limit to how much you can put in general provision. You cannot just forever say, okay, we're going to put this loan in general provision. At some point in time, you're going to have to write it off. So this person asked the question, but more or less, she has thought about this deeply and provided her own answer, which I think is good. Okay, so you ask the question and you try to speculate what the answer might be. Is everyone okay with that? All right, and then now on the, okay, I'm going to go to question 3. So on the lecture notes, I see that perpetual instruments must contain no incentive for the issuer to redeem. But then I see below, the example below, and it says the tenor is non-call 5 years. My question is, how can the bank say it is non-callable 5 years? If they say so, doesn't it mean it has the incentive to redeem after 5 years? And how do people tell if the bank have incentive to redeem in a general speaking manner? Excellent question. And it's one of those things that is not immediately obvious. And it's not the sort of thing that you can find answers in textbooks either. Okay, now just very quickly refresh yourself with this slide. So we're talking AT1, which principally either preference shares or what we call COCOs, Contingent Convertible Bonds. Now, today is probably a good window for us to discuss this a little bit. Contingent convertibles have been and may still be, although they don't issue them as much these days, they were very, very popular as a class of instrument, especially for high net worth individuals and some hedge funds. A few years ago, I had alumni who have left our program and they have gone into the wealth management industry, private banking, and they came back just a few months later with questions on these, and they say, yeah, now I can really relate to it because these things were really in high demand. It will become obvious in a moment why they're in high demand. But now, first of all, just very quickly, pref shares. So when you are when you talk about the balance sheet of a corporation, there can be different types of capital. Okay, so apart from your, so senior secure. I'm talking about any typical organization out there, and it doesn't have to be banks. And then there is the senior unsecured. So senior secure is you have some kind of collateral backing it up, and then you have sometimes called junior bonds or subordinated bonds, subordinated debt. Okay, subordinated, and then you get into this. So if this is the equity land, you get into an interesting space here with hybrids. The hybrids are instruments that look a little bit like fixed income and a little bit like equity. To give you some examples, convertible bonds. Now these are convertibles when the investor buys a bond, but the investor has a right to convert them into shares. Okay, and you would do that when share price is very high, of course. Okay, and then there are so-called perpetuals. Perpetuals are bonds without a maturity date, so no finite maturity date, and fixed coupon. But often these are actually callable with step-up coupon. Now more on that in a moment. Okay, and then you can have you can have COCOs or contingent convertibles. Convert, and then you can even have preference shares. Okay. Now again, these. Now, what is the difference between this one and this one and this one? So perpetuals, as I said, no maturity date, and fixed coupon, often callable with step-ups. Pref shares, they do share these characteristics, although these are called shares now. Okay, now, so there's a lot of, there are similarities between just your standard perpetual bonds and preference shares, in the sense that both of them don't have maturities, and they usually, so that in the case of pref shares, they wouldn't call them coupons. They will give you a dividend, a fixed dividend. Okay. Now there are some differences, some subtle differences. The first one is the payment flexibility can be different between these. You just have to read the prospectus. So it could be that the perpetuals, they have to pay the coupon, but the pref shares, sometimes you may be allowed to miss a payment and then pay in the next quarter. The second thing that would make them different is the taxation treatment. So if you have a perpetual, you are being paid coupon income, but if you have pref shares, the tax treatment can be different, and you may even be subject to capital gains tax. Okay. The third difference is in terms of claims priority. So a perpetual bond, strictly speaking, is still a bond, so it will be slightly higher than a pref share. Although if a company goes bankrupt and you are holding a perpetual, I mean, look, don't be too optimistic, okay? But anyway, my point to you is about these contingent convertibles, because that was the question, okay? Let's not lose sight of the question. What was the question? This is the question, okay? Take a moment to read that. Now, there are two issues here, okay? So the first issue is whether an instrument is callable or not. And the second issue is whether the instrument contains a coupon step-up. Now let's deal with these separately. Okay. And let's say you have just a normal, perpetual bond. Perpetual bond. What do I mean by normal? No maturity date, fixed coupon, and then callable. Now, so you have a normal perpetual bond, and then you have these so-called COCO bonds, or contingent convertible. And these can be counted as additional tier 1 capital. Okay. Now, how are they different? So, are they callable? In both instances, yes. But when you talk about coupon step-up, perpetual bonds often have step-ups, but by law, contingent convertibles are not allowed to have that. Now, I'll tell you what is the coupon step-up? What kind of signal is it actually sending to people? So first of all, the call part. You have to think of that, I guess, in connection with the coupon step-up. So these so-called very long dated instruments, if this is time, and these are the coupons. So you can imagine you buy something that technically can last 5,000 years, in theory, and it pays you a coupon for 5 years. And at the end of that, one of two things might happen. Either they get called, or if they're not called by the issuer, called at par normally. Okay, it doesn't have to be. Otherwise, the coupon will step up. Now, this is the normal type of. So from year 6, the coupon steps up. So this is sending a signal to investors. Hey, look, although this instrument is supposed to last forever, we really have an incentive to give you back your money, because if we don't, maybe the coupon goes up to 7%. Now, these are the normal type of perpetuals. With the COCO bonds, which are qualified to be considered as AT1, you are not allowed to do that. So the coupon stays the same. Now, please listen carefully. This is a requirement. This is a structural requirement by law. When you issue something and you say that it is AT1 qualified, then you are not allowed. It's not because you don't want to. You are not allowed to introduce step-ups. Now, this is actually sending a different signal to the market. Maybe the coupons actually will be higher. Maybe the coupons are not even 5%, so they can all get lifted to 6.5 or whatever. Okay, if you are not allowed to have a step up, then there is less incentive for you to call it back. So the capital is likely to stay there for a longer period of time. Now, that is exactly what regulators want to see. If you want to say something qualifies as AT1, they don't want to see that money disappearing. Okay, so it is, a different market in a way, compared to just your standard perpetuals. And I repeat, it is not because issuers don't want to call them, okay, but by removing the incentive for them to call, this type of capital is likely to stay around the balance sheet for longer, which is what regulators want to see. All right. The last point to mention is that, and please remember this, things like COCOs, this is a class of instruments that is only available from banks. You don't see Country Garden or China Mobile issuing a contingent convertible, because it is contingent upon, certain CAR related balance sheet events. Okay, capital adequacy ratio. Let me show you that, just for your interest. Now, let me see. Another. Yeah. So this is an AT1. This is an example. These are all in your notes. Okay, but this is perpetual. So you can see that even with an AT1, it can be callable, but it will not have a coupon step up. Okay. And let me now return to our notes. By the way, you can please go in and sign your attendance in Blackboard. There's a simple question for you to answer. Okay. Now, I want to just selectively share with you. So the capital spectrum, as I said, there are different types of bonds. I said that earlier. So there's senior secure, senior unsecured, the junior debt, and things that look like equity, perpetuals and preferred stocks. But this this table does not differentiate between banks and non-bank issuers. And the following slides will give you more ideas. Okay. Now, what then is a contingent convertible? Like I said, this is a class of instrument that is very popular. If ever you enter into the private banking or wealth management industry, chances are you will come into contact with it. And if you know about it now, that puts you at an advantage when you go for job interviews. Okay. Now, I think the COCO is a reflection on the innovative genius of the finance industry. Whenever there is a problem, we think of a way to solve it. Now, what was the problem? The problem was, for a long time, if this was the size of a bank's balance sheet, so regulators all over the world have been asking banks, hey, issue more capital, issue more capital, issue more capital. And then when they get the cash for that, first of all, a lot of the cash they get, they're not allowed to use. So these became this buffer and that buffer and counter-cyclical buffer and systemic buffer. So in the end, you just stuck with piles of cash and you're not allowed to deploy it. So immediately what you can see is that it's going to hurt your return on equity. You have a big balance sheet, but only this part is working hard to make money for shareholders, because that was the way you were running it before. So bankers became very unhappy, and investors and shareholders of banks also became very unhappy. So they thought, okay, why don't we come up with a different idea? The idea was we would keep the equity part more or less the same. So this box is supposed to be the same as this box. However, we are going to issue another kind of instrument where they look like bonds, they pay like bonds, but if ever the bank gets in trouble, suddenly this is converted into equity. In other words, you pay $100, you invest in these things, and you expect that someday you will get $100 back, or if you sell it in the market, you will get $100. Someday you might find that suddenly you are a shareholder holding 25 shares or whatever, and when you multiply by the share price at that time, it would not be $100, definitely. Okay, so that's the idea. Now, what do these things actually? So like I said, it looks like a bond, but it can become equity. Now, how do you price that? This is kind of convertible bond, but the conversion right is triggered by certain conditions, and I'll show you what those are in a moment. Okay, now this was invented roughly just in the aftermath of the global financial crisis, and they were invented for the reasons I was telling you a few minutes ago. They were very warmly received by investors. Investors love these, and don't worry about a COCO. There was one that was issued by the Bank of Cyprus. It's just a compound option. You can look into that later if you like. Now, so here is a page of contingent convertible bonds. This is courtesy of my good friend Sherry Ma, and the thing to watch out for. So the names at the top would be familiar to you. So it's the Standard Charter, HSBC, DNB. Now, what is of interest? So first of all, what is the structure? So these are perpetual non-call 5 or non-call 10. So you can call them after 5 years, after 10 years. That's the first thing, okay? Second thing, the coupons, they do not step up. This is not a step up. This is actually two different tranches. No step up, no step up, no step up, okay? The third thing, which is of interest, is the loss absorption trigger. So this goes back to the very first question that a student was asking, okay? And the trigger is 7% of CET1. You see, no wonder she had that question. Okay, hold on a second. I thought the minimum CET1 requirement was 4.5, what it was, and then in Europe at least it got lifted to 7. And ING is a European bank, as you know. 7%, 7%. DNB, don't know where they came from. 5.5. Okay. Now you can look to the next page. There are some more deals. This one was a very successful issue some years ago now. Okay, 7 years ago. Again, what do we look for? Well, I mean, look, the size is interesting. So 6.5 billion, that's a lot of money. Okay, 6.5 billion, these are US dollars. 6.5 billion US dollars. Coupon, no step up, no step up. Just one coupon, that's it. Maturity and call. I hope you can read this small print. Perpetual, non-call 6. That's a funny number. Non-call 6. This is perm non-call 5. A lot of you Middle Eastern bank. I think this is a bank with a camel on the logo. I don't know where NBK is. Okay. And this is Dubai. Okay. Bank of China. And then perpetual but callable. Okay, so in order for you to be AT1 qualified, you do have to satisfy certain criteria. Now, so there's a loss absorption trigger. Again, 5.125 of CET1. I mean, Bank of China has. You saw that last time, didn't you? At least Bank of China, the Hong Kong branch, had a capital adequacy ratio close to 20%. It's 4 times this trigger. Okay, so they're far, far away from it. Yeah, I think the other things are not so important. Okay, so have a look at these because one day this is what you will be presenting to clients. So you know, you can't do that unless you are comfortable reading this stuff and then you know the differences. All right. This is a write-up, more details on the actual Bank of China trade, which will be of interest to you. Why was it good? And you know, why is it that investors were keen to buy, and they really were. So this refers to this deal on the previous page, this one. Okay, and some more. These are just the commercial. detailed commercial terms on the Bank of China deal. I think you should try and read that and see what you get from it. All right. Now I'm not going to talk about this today, but let me just summarize what we've done today. So we had a bit of housekeeping, and I wanted to let you know there is a midterm exam coming up in 2 weeks. It will, I think, be 2 hours with questions, short questions and multiple choice. It is likely to be open book. I will confirm that with Ruben later on. And then for your financing proposal, what do you need to do for that? We would like you to let us know actually what company you intend to cover. Okay, so I'm going to send out an email to everyone and a representative can, because we don't want any overlaps. Okay, we want everyone to be there. There are a million companies out there, so why do you need to overlap? I don't think so. Okay. And then I showed you some sample presentations and sample reports from there. And we had a look at short selling briefly. And we had a look at some questions that were provided to me by one of the students, and I'm so grateful for that. Thank you. Keep writing to me. The one piece of advice that I can give you for the next 7 days is when you are, in the course of your revision, if you have any questions with the material, write to me. Let me know, and we'll do our best to help you. The earlier you do so, the better response, or the more preparation time we have. Okay. Please sign your attendance between now and 10:15. So you should have another 20 minutes or so. All right. Is everyone okay? Are you guys happy? Are there any questions? If not, I might let you go early. And it's a nice day out there. And we'll see you guys again in the afternoon. All right. Thank you, everyone. Okay, no, hold on. Okay, I'm gonna cut the recording. Okay, thank you, everyone, and see you shortly. Bye bye.